Have you ever wondered what the future of retirement savings looks like, especially for the younger generation? In recent years, there's been a significant shift in the retirement savings landscape. Not too long ago, $1 million was considered the gold standard for a comfortable retirement. It might not have allowed for a life of luxury, but it was enough to live on if you were at retirement age. However, the tides have turned. With the rise in living expenses, inflation, and the increasing cost of healthcare, experts are now suggesting that $1 million might not cut it anymore, particularly for the younger folks like millennials. According to the financial website Seeking Alpha, if you're planning to retire in about 30 years, you should aim to have a staggering $3.6 million tucked away for your golden years. If that sounds outrageous, hold on to your hats, because it's even suggested that people should round up this number and aim for a minimum of $4 million. But what's driving this massive increase? Well, we can't ignore the elephant in the room: inflation. Over time, the value of money decreases, meaning the purchasing power of $1 million today won't be the same in 30 years. Additionally, the costs of healthcare and other living expenses are skyrocketing at a pace that's hard to keep up with. This means that the cost of maintaining a decent standard of living during retirement is expected to be significantly higher in the future. So, are we doomed to work forever, or is there a way out of this seemingly impossible situation? Scene script. Let's delve into the numbers, shall we? First off, we have the Secure Act 2.0, a retirement legislation that may increase the catch-up contribution limit for older 401k participants. At present, those age 50 or older can contribute an additional $6,500 on top of the federal contribution limit of $20,500, making a total of $27,000 per year. The House bill suggests upping the catch-up contribution limit to $10,000 for individuals aged 62, 63, and 64. This would allow these individuals to save up to $30,500 in their 401ks. A similar Senate bill suggests raising the catch-up contribution limit to $10,000 for those aged 60 and older. However, the House bill also includes a provision to Rothify catch-up contributions, which means they would be deposited into a Roth 401k account, requiring individuals to pay income tax on the contribution up front. The Senate proposals do not include this provision, and the two will need to negotiate their differences. But bear in mind, this expanded catch-up provision is expected to benefit a small minority of participants, primarily high-income earners who already max out their 401 coates. Next, we turn to Fidelity Investments data on 401k savings rates and balances. Despite concerns of a possible recession and falling markets, 401k participants maintained steady savings rates in the fourth quarter of last year. The average 401k savings rate held at 13.7%, with baby boomers having the highest rate at 16.5% and Gen Z workers saving 10.2%. The average 401k balance rose 7% to $103,900, but it's still 23% below the end of 2021. Lastly, let's touch on the trend of adult children moving back home and its impact on parents' retirement savings. This can be a double-edged sword. If parents are spending more to support their adult children, it can eat into their retirement savings. On the other hand, if done correctly, having adult children contribute financially can actually help parents save more. These numbers paint a rather grim picture, but is there a silver lining? With these new realities in mind, what challenges and opportunities lie ahead for the younger generation? Let's face it, the challenges are real and they are daunting. The younger generation is staring at a future where they need to save more than 3 times the once gold standard of $1 million for retirement. That's a steep mountain to climb, especially when considering factors like increasing living expenses, the burden of student loans, and the unpredictability of the economy, not to mention the evolving retirement legislation that could change the rules of the game at any moment. However, it's not all doom and gloom. Challenges often bring about opportunities, and this situation is no different. The first opportunity lies in financial literacy. The current scenario has highlighted the importance of understanding personal finance, retirement savings, and investment strategies. There's a wealth of knowledge out there, and the younger generation has the advantage of time to learn, adapt, and implement these strategies. Another opportunity comes in the form of technology. Fintech has revolutionized how we manage our finances, making it easier than ever to start saving early and consistently. From robo-advisors to budgeting apps, technology is making finance more accessible and manageable. Moreover, legislative changes like the Secure Act 2.0, despite their complexities, could provide new avenues for savings. The proposed increase in the catch-up contribution limit, for instance, could allow older workers to boost their retirement savings significantly. While this primarily benefits high-income earners who already max out their 401ks, it's a step towards addressing the retirement savings gap. And remember, having a large retirement goal isn't necessarily a bad thing. It can motivate us to save more, spend less, and make smarter financial decisions. It's about turning the challenge into an opportunity. So yes, the landscape is changing, but with the right knowledge and strategies, we can navigate it successfully. So how can we navigate this changing landscape and ensure a comfortable retirement? Let's dive into some strategies for future retirement savings. First and foremost, it's never too early to start saving. The earlier you begin, the longer your money has to grow. Thanks to the magic of compound interest, even small contributions can accumulate into a significant nest egg over time. Yet, be aware that starting early also means a commitment to a long-term strategy. Next, make sure you're maximizing your employer-matched contributions if you have them. This is essentially free money that your employer adds to your retirement savings. By not taking full advantage of this, you're leaving money on the table. Diversifying your investments is also a crucial strategy. This means spreading your investments across various types such as stocks, bonds, and other asset classes to reduce risk. While diversification doesn't guarantee profits or protect against loss, it can be an effective strategy to reach long-range financial goals while minimizing risk. Consider alternative retirement savings plans as well. With the potential increase in the catch-up contribution limit for older 401k participants as proposed by the Secure Act 2.0, higher savings balances in retirement and potential tax advantages could be achieved. However, remember that every strategy comes with its own set of potential benefits and drawbacks. For instance, while starting to save early gives your money more time to grow, it also means you'll need to commit to a savings plan for a longer period. Similarly, while diversifying your investments can help spread risk, it requires a balanced understanding of different investment types. While the future may seem daunting, remember that with the right plan and dedication, achieving a comfortable retirement is still within reach. We've covered a lot of ground today, and it's time to wrap up. The landscape of retirement savings is changing, and we are all part of this transformation. The traditional goal of having $1 million saved up for retirement, once seen as a golden standard, is now being challenged by the rising costs of living and the unpredictability of inflation. In our exploration, we've seen how new legislations like the Secure Act 2.0 are stepping up to the plate, potentially increasing the catch-up contribution limit for older 401k participants. We've also witnessed the resilience of 401k participants who, despite economic uncertainties, have maintained steady savings rates. Yet the future is not without its challenges. The rising costs of healthcare, the increasing life expectancy, and the unpredictable economic environment are all factors that can significantly impact our retirement savings. But it's not all doom and gloom. Opportunities are present too. For instance, the potential to Rothify catch-up contributions could offer tax advantages, while the prospect of adult children contributing financially to household expenses could lower costs and leave more for savings. As we navigate this changing landscape, the strategies for successful future retirement savings are evolving too. From diversifying income streams to maximizing contributions to retirement accounts and making the most of catch-up contributions, there's plenty we can do to prepare for the future. Yes, the future of retirement savings may look different, but it's not necessarily bleak. With knowledge, planning, and perseverance, we can still achieve a comfortable retirement. So keep learning, keep planning, and keep saving. The future is in your hands.